Good afternoon, everyone. My name is David Roberts. I'm the Investment Director at the House Crowd. Today, I'm going to be talking to you about how to generate a meaningful income from your savings whilst keeping your principal capital as safe as possible. With savings rates at an all-time low and the cost of living constantly increasing, it's more important than it's ever been to really think about where your money is and what it's doing for you if you want to be able to enjoy a comfortable retirement. We all have this feeling that things are getting more and more expensive every year, but we probably don't look at the numbers in black and white and think about the effect that that's actually having on our savings investments. The Office of National Statistics, whose job it is to put that feeling that we all have into the official numbers, said that inflation was just over, 3% last year. So for every pound you had in your pocket or your savings account last year that wasn't invested and growing, it's worth the equivalent of 97 pence today, and that's going to continue to decrease as the cost of living rises. So if you had money sitting in a savings account over the last 4 years, which I'm sure many of us have done, it would have lost the equivalent of 10% of its value. Now, if your bank manager, not that we even really have bank managers anymore, called you up and said, we're going to be charging you 3% to leave your money on deposit in a current account, we'd probably will hit the roof, but that's the equivalent of what's happening. So we can all agree probably that the cost of living is going to continue to keep on rising, and that if we're just looking at traditional savings investments, it's barely going to pay enough to cover the cost of inflation, never mind putting anything meaningful back into our pockets in the form of income. So you've worked hard, you've saved hard, you've built up this nest egg for yourself. It doesn't matter what that amount is, but it's something that's important to you. And you're probably imagining yourself on the golf course or on a beach somewhere, blissfully knowing that having spent sort of many years working hard, your investments are now finally working hard for you. And this is the dream that most people have, but what's the reality? What most people do is they leave it sitting in the bank, gathering dust, and its value's decreasing every single year. And you can forget about getting any kind of income. If you had £100,000 sitting in a Halifax account, that would generate you £200 a year of income. So £200 from £100,000 invested is pretty frightening, and you'd probably be taxed on that as well. Now, even worse than poor investment returns is poor investment decisions. So investment scams, high-risk investments. Once you've built up a lump sum and you're thinking about enjoying the later years of your life, the absolute worst thing you can be doing is to start losing big chunks of capital. You hear these unfortunate stories in the paper about people that have worked hard their entire life, and in a matter of days or weeks or months, they've managed to lose everything with one bad investment decision. There's a saying that I particularly like: pay attention to the small print, it's far more important than the selling price. And I think this is very, very true of investments. In the course of what I do, I see some people so dazzled sometimes by the prospect of these fantastic returns that they're being offered that they forget to read the small print. And if they really understood the risks they were taking to be able to achieve these, they might not be so keen to do them. So when you're looking at an investment proposition, and maybe especially so with a lot of the new things that are coming out, like peer-to-peer lending, first thing I would say is do your research really, really thoroughly. Satisfy yourself that you're happy with what you're investing in. Look for sources of validation. Is the company authorised and regulated by the Financial Conduct Authority? It's not to say you can't lose money investing with a regulated business, but it's a sign of credibility with sort of a lot of the new companies you should be looking for. Has that company got good reviews on websites like Trustpilot if they've been around for a period of time? What are their existing investors saying about their experiences of investing money with them? And another thing as well, in just us as human beings, I think too many people, when they make investment, they just presume that things are going to go exactly as planned, and they see a forecast on someone's marketing literature and they think that's exactly how it's going to go. And if you've been around on this planet long enough to reach retirement, build up a lump sum of capital yourself, you probably realise by now that in life things don't always go to plan, even if someone's got the best intentions. So I would sort of challenge you to say, do you know where your investments stand when things go wrong? So if the property market dropped 25% tomorrow, if the stock market dropped 25% tomorrow, where does that leave your capital? Would you be losing any of it? Would you be losing some of it? Would you be losing all of it? So if you don't know the answers to these questions when you're making investments, you really should. So I'm going to give you a real example. Now, would you rather have a 9% return or a 15% return? And let's just presume that both of these are marketed as a secure property investment. Now, most people, if you're just looking at surface level information, you perceive these to be similar. We'd want 50%. Everyone wants more for their money. And you'd be shocked in the course of me speaking with a lot of people about investments, how many people just work off of surface level information. They really don't go into the details of investments and make adjustments for the risks they're actually taking to be able to achieve that return. So I'm going to ask you another question which takes into account the risk-adjusted returns. So investment A on the left here, the 9% return. With this investment, if property values fell by 25%, the investor would almost certainly not lose any of the initial capital they put into it. Now, with investment B, the 15% return, if property values dropped by just 20%, the investor would lose absolutely everything. So a 9% return where it can drop 25%, you won't lose any of your initial capital, or 15% where if it drops 20%, you're going to lose absolutely everything. So which would you choose now with the benefit of this information? So this is actually a real example from one of my clients in a conversation we had when she started investing. The one on the left, the 9%, was a house crowd investment we were discussing at the time. This 15% investment was something she'd been offered at this very highly leveraged off-plan property development. And once she understood the much greater risk that she was taking on her capital to be able to achieve this high return, she felt in her circumstances that it wasn't worth potentially losing everything if things didn't go to plan. So I would say it's important at any stage in your life, but even more so in retirement, that the preservation of your capital is probably more important than the overall return that you're actually getting. And there's a famous investor who I'm sure many of you have heard of, who once said, rule number 1 is to never lose your money. And rule number 2 is to never forget rule number 1. And with this in mind, I would say one of the greatest strengths of our investment model at the House Crowd is not just being able to deliver you fantastic returns when things are going to plan, but the safety nets that are in place to protect your capital when things don't go to plan. So how do we do this? Our model is what's known as secured lending. So we will only lend money to property owners, and we will take a legal charge at the land registry over their property as the security for that loan. Now, the funny thing is that I would say probably every single person in this room, your money is already being used for secured lending. You may not know about it, and if you do know about it, then you know you're probably not getting your fair share of it. So when you go and put your money in a high street bank, Halifax, Barclays, whoever, nearly every high street bank, they will use your money to make secured loans against property. They'll give the money in the form of mortgages or as loans to property developers, and they will often lend people up to 90% of that property's value. And believe it, there was a time when they would lend 100%, 110% of a property's value. So that gives you some feeling about how major financial institutions feel about property security as an asset class. Now, they will make very high returns from the borrowers through interest, through application fees, exit fees, penalty fees, default fees. It's very, very profitable for them. And so you guys are already all investors in this market. So what are you getting for them using your money? You're getting that 0.2 savings rate at the Halifax that we talked about earlier. So it's not really a fair deal. Now, it's important to remember that when your money is in a bank, obviously it's insured by the Financial Services Compensation Scheme up to £85,000. But so for anyone that feels that what we're talking about is a bit of an alien concept, you're already in this market and you have been for a long time, you just don't get your fair share of it. So at the House Crowd, we allow you to lend money fully secured against property exactly the same way that the banks do it, except instead of lending up to 90% of a property's value, the maximum we'll ever go up to is 75% of a property's value. And instead of that 0.2% you're getting in the savings account, the typical return for our peer-to-peer loans over the last 3 years has been 9.2%. And with our development finance products, you can earn up to 10%. And this is what's commonly referred to as peer-to-peer lending. It's a term some of you may be familiar with. It's becoming a lot more prevalent. But all it really means is that via a platform like the House Crowd, you're cutting out the banks, you're lending directly to property owners looking for finance, you're getting a very high level of security, and you're going to be reaping all of the rewards of that loan for yourself. Now, whilst we're on the subject of banks, have you ever wondered why the banks, with all the billions of pounds that they have available, don't just go out and buy properties themselves? So banks like to invest in property with debt rather than equity because it gives them income and it gives them control. Smaller investors and the man and the woman on the street, we kind of have this very flawed logic that property is just all about capital gains, and we're very quick to forget the property market is cyclical. It can come up, it can come back down again, and whether you like it or not, you're a passenger in that, and you've got absolutely no control over it. It's going to take you wherever it wants to take you. Now, with equity investing in property, you're hoping that you can get in and out at the right times. And believe me, there are plenty of people who have sat on properties for many, many years, maybe not so much in London, the South East, with very little income, hoping for capital gains that never actually materialised. Plus you have all the headache of maintenance, financing. Buy-to-let is a whole other conversation for another day, but it's really no longer the panacea that it's been made out to be. And we're seeing huge amounts of people that are looking to sort of cash in their buy-to-let properties, get rid of the headache, it's less hassle, and they can earn more money from doing debt-based property investing. So the banks, the hedge funds, the big investors, they know that the income is more important than capital gains. They're not thinking to themselves, what might this investment do in 10 years' time if the wind keeps blowing in the right direction? They're thinking to themselves, what cash flow is this going to be putting into my pocket today? And secondly, the control that you get from secured lending means that it isn't as susceptible to property market cycles. And even in bad times, when the market is kind of flat or it's coming down a bit, very much like it is at the moment, you can still have reliable income flowing into your pocket. So I'm going to go into a little bit more detail about the actual structure of our house crowd investments. So people that want to borrow money will come to the house crowd through a network of our introducers and our brokers, and we will only ever lend money secured against property. There are other peer-to-peer platforms that will do peer-to-peer lending against unsecured personal loans, business loans, startup loans, sometimes even at the same rates or less as we're offering secured against property. Now, going back to the point I made before about how much risk are you taking to achieve any given return, when a private borrower or a business isn't in a position to pay you back, it can be very difficult to recover any of the money you've lent them. Whereas when you have a physical property and you've only lent them, for example, 50, 60, 70% of that property's market value, you can see it gives you a much greater level of security, and that's what helps to keep this initial capital protected against any losses. Now, a borrower will come to us, and if they pass our initial due diligence checks, we'll proceed to a valuation on their property asset. Now, we don't take what the borrower thinks their property's worth. It'd be too much, almost certainly. We don't take what an estate agent thinks their property would worth. Again, probably be too much. We would instruct a RICS surveyor, Royal Institute of Chartered Surveyors, to do a full valuation report on this property asset, exactly the same as a bank would do if they were giving you a mortgage. So the whole process of lending money on every single deal we do is very much like a property conveyancing process where you have solicitors on either side, lawyers, credit checks, and in some instances I'd say it's a lot more rigorous than a conveyancing process, so that gives you a lot of confidence as the investor. So to keep things simple, let's just say that the RICS surveyor has said that this given property is worth £500,000, and we would be happy to lend them up to a maximum of 75% of that property's value, which is £375,000. And the other thing is these loans are never for any longer than 12 months. This is short-term secured lending. So if you think about what I said earlier about preparing for the worst-case scenario, if for any reason at the end of the 12-month term this borrower wasn't in a position to pay back the loan on the property and we were forced to repossess this property from them and the property values had fallen by 25% as well, there's still a very high chance you will be walking out of that deal without any losses of your initial capital. So the important thing is we've got the legal right to sell the property at its full market value, and we've only ever lent these people a percentage of what their property's worth. So this is an investment model that is able to generate fantastic returns for you guys as the investors, but also you have very high levels of security because everything's tied against physical bricks and mortar. Now, this particular example here is sorry, just to take a step back, just to give you an example, a 75% loan to value secured loan like this would typically pay you, the investor, about a 9% return. Now, something that I always get asked, so I'll say it now, there are no management fees, there are no other hidden charges or fees. If you were to invest £10,000 into a loan like this and it performed as we've said, £10,900 would be coming straight back to you with no other deductions. It's very transparent and there's nothing hidden in terms of the charges. So 75% is the maximum level of loan to value that we'll go up to, but we also have plenty of loans that are more conservative. So this illustration here shows you a 50% loan to value loan. I did one the other day that was in Vauxhall in London, not too far from here. That was at 44% loan to value. That paid the investors a 5.5% return. So 5.5% is still a very attractive return. And the risk that you would be taking on that as the investor is, do I feel that in the next 12 months, property prices in Vauxhall are going to fall by 56%? And if they did, that would just be breaking even. That wouldn't be capital losses at that stage. So I think even people that maybe traditionally wouldn't be property people and are a bit pessimistic about the market, you can still find something where you're very comfortable with in terms of the loan to values that we're going to. So if you're investing into individual projects, you've got complete flexibility. You can choose whether you want a 75% loan to value, a 50% loan to value, a 30, a 40, a 60. You're looking at the properties on an individual basis, each with its own valuation report. So you can build your own portfolio within our platform of secured loans where you feel comfortable in the properties that you're lending against. So if you decide to invest into either our Auto Invest or any of our ISA products, your money is automatically diversified across lots of different loans that have all been made at less than the property's value. And then, like I said, for any reason, if that borrower doesn't pay back the loan, we've got the right to repossess and sell the property at its full market value. So at the House Crowd, we believe that when it comes to lending, property is the ultimate security. We've been in business since 2011. We were the first ever property crowdfunding platform in the world. We've won numerous industry awards, including Property Crowdfunding Platform of the Year. And we have a team of 30 staff based up at our head office in Manchester. And we're all working hard every single day to make sure that the 16,000 investors that we have registered on our platform have an amazing investment experience. Through the platform, we've raised it's a bit more than that now. I think it's about 80 million, 79 million pounds. We've paid out 22 million pounds in returns to investors. The actual average return our investors have been receiving in secured loans over the last 3 years was 9.2%. And because of the capital preservation measures that I've spoken about, we're proud to say over the last 7 years, we've had 0 losses to investor capital. So just to summarise, if you have a lump sum and you're looking for investment income in your retirement, beware of inflation that's going to eat into your savings when you have it sitting in the bank doing nothing. Make sure you avoid, like the plague, high-risk investments and investment scams that expose your capital to high amounts of risk. Find a balance of risk and reward that works for you. Everyone's going to be different, and really focus on capital preservation. We would say invest for income rather than capital gains, especially if you're retiring. You really want to be able to enjoy the income from your investments now, not wait for the future for something that may never materialise. And lastly, I'd say take advantage of tax-free investing. I'm sure most people in this room have already paid more than their fair share of tax to the government. So if you can invest in the House Crowd for up to £20,000 a year, completely tax-free through the HMRC-approved Innovative Finance ISA. Depending on what your exact tax status is, that could make the 7% ISA rate the equivalent of a 10 to 12% return outside of the ISA. So I'm going to leave you with some numbers that I think really represent the point that I'm trying to make today. If you had £100,000 and you'd had it sitting in a bank account, a Halifax account for the last 3 years, that would have given you £600 of income in 3 years. Whereas if you had the same £100,000 invested at the actual rate that our investors have been getting with secured lending, it would have given you £27,600. So £27,000 is a huge difference. It can make a big difference to the quality of your life in retirement, whether that's offsetting your living expenses, holidays, treating the children, the grandchildren. I'm sure everyone in this room is looking for a safe way to generate income from themselves in retirement. The CEO of the House Crowd, Fraser Fernhead, has written a very interesting book called The Alternative Guide to Property Investment. This has got tons of information about us, other crowdfunding platforms. It's a very interesting read. If you would like a free copy of this book, I've run out of paper copies, but I'm taking people's details. If you would like a free copy of the book, come and see me. I'll take your details and I'll make sure you get a copy within the next week or so. I don't think we're doing any questions, but if you have, I'm based in London. If anyone has, please take my email address down. If this is something you think might be of interest, I'd highly recommend us having a chat, sit down and talk through this in more detail and ask any questions you've got. I'm going to be hanging around for a little while afterwards, and I look forward to speaking with some of you. Thanks a lot, guys.